Now let's have a quick look at the mechanism of GST. It's more for the business people to worry about rather than for us, because we will see it in the bill and we have to pay. So in terms of mechanics, you can see words like output tax, input tax. Output tax is the GST charged on the customer. Whoever is your customer, you will be charged the output tax. And input tax is the GST collected by the supplier. Whoever has supplied you the goods has charged you GST as output tax. But you have paid, so you are still in the business, so it's an input tax for you. Right? So a taxable person, as you see there, a taxable person is entitled to offset the input tax incurred against the output tax collected. So this we are referring to the business people. A taxable person is the one who's going to be the agent of the government. So he's going to pay input tax and he's going to charge the customer output tax. So the input tax he will collect from the government. Either if he has no output tax, he will collect it in the form of refund. If he has output tax, he will try to offset the input tax and only pay the balance to the government. Right? Now here is an example of how the system will work, the mechanics of it. And you can see, I think this is easier for me to see, since it's much larger. So I suppose it's easier to find when I'm closer to the microscope. So you can see here, raw material is imported, all right? And let's say it's $1,000. And GST is charged on it at import. So there's a 6%, $60. So this GST is paid to the government through the customs. So government collects $60 there. The manufacturer adds on his cost and profit element and sells it for $1,500. So he has to incorporate the GST as paid and incorporate the output tax into his selling price. So you see, the 1,060 now becomes 1,590. And you can see there, GST collected from wholesaler. You can use the word wrongly, I mean the raw material, $90. You can use the wrong word there. GST incurred at importation. And so the difference charged by this manufacturer when he sells to the wholesaler. So in a sense, right, because the manufacturer is charging to the wholesaler. So the difference, $30, is paid over to the customs, who is actually collecting on behalf of the government. Right? So you can see the whole chain there. Import and manufacturer sells to wholesaler, wholesaler sells to retailer. So assuming here that each of them are putting a loading of $5 for their own cost and profit, and you find that ultimately the tax collected is $150, which the customer pays. So progressively the money goes to the government. $60 there, $30 here, another $30 here, and another finally. So you call it a multi-stage tax. So each stage tax is collected. But only the amount relating to the value added by each person in the chain is handed over to the government. Right? Now let's look at this illustration. It's basically the same thing, but look at this. Non-GST registered. So just now we said a person who can collect tax is a taxable person, and he has to be registered. All right. And if a person is not registered, he cannot collect the GST. So in this case here, this wholesaler is non-registered. So he cannot charge GST. So what it means here is that if along the chain there, if there's one guy who is not registered for GST, compared to the earlier scenario where everybody is registered, right? All are registered, the GST collected by the government is going to be higher. All right? It's going to be higher. So one of the implications of this message is that your business relationship may have to change. The business relationships have to change. Otherwise, you're going to, assuming that everybody wants to make $500 there, of course it may not be the case, then you may have to choose your supplier to be a registered person rather than an unregistered person, because the implication to the customer is quite heavy. Compared to $150, as you can see there, $245. A lot. Customer is, if you're going to load a customer with higher prices, he is going to look for cheaper sources. Okay, scope of tax. Let's have a quick look at scope of tax. GST, of course, will cover things made in Malaysia. It must be a taxable supply. Later we'll come across what we mean by taxable supply. It must be made by a taxable person. So when we say taxable person, he's the one who's registered. Just now we said someone who's not registered, he can't charge. It must be a registered person, then he will be supposed to charge. And in the course of furtherance of any business. So the businessman, if you're doing or engaging in business activities and you're registered, then you have to charge. All right, you have to charge GST. So scope also covers goods imported, not only goods made in Malaysia as we saw just now, but also goods imported. Whether it comes by air, sea, rail, road, post, courier, and carried. And carried, we may come back from overseas trips. So this is a thought I had. I told my wife, every year we go overseas to see our children. When we come back, we buy chocolates and other stuff and come. We do not know whether we can just walk into the green lane and come out. Whether you stop and say, have you paid your GST? That one we do not know how they're going to react. So come 1st April, we will know whether customs are going to let us go or more spot checks to see whether we have anything to declare for GST. Because we are going to consume it here. All right? So import tax, maybe they don't want import duty, they may not want to charge because small amount. And normally we go more than several days, it's up to a certain level, no tax. But there's no such thing as regards GST. So they may still want to charge us GST because we say we brought the goods in for consumption. So as you see, importation, Malaysian customs control on importation. Example, clearance the imported goods, you pay your GST at point of importation. In some goods, there may be import relief. There may be relief by through application, you may be able to get relief if they are classified for relief. Okay, let's have a quick comparison. Importation versus supplies made in Malaysia. So you can see in the case of importation, the customs collect the GST at the point of entry. All importation goods are subject to GST except where import relief is granted. Right? So those goods are obviously won't be charged GST. GST is chargeable regardless whether the goods are imported for a consideration. Means whether you're paying for it or not, if you're importing it, GST will be charged. Consideration is whether you're making payment for Whereas here, supplies made in Malaysia, you can see GST is collected by GST registered businesses. So the businesses are going to be the agents of the government. And you know, in the case of tax, they are not going to pay you to do the work. Alright? But you got to do. You got to do. Only supplies made by registered taxable person are subject to GST. So if the person is not registered, like we saw just now, the wholesaler is not registered, he cannot charge the retailer GST. Right? But there's one difference here compared to this. Only supply done for consideration is supply for GST purposes. Whereas here, regardless whether goods imported are for consideration. So slight difference. Now reverse charge. Now services are also included in GST. Now, if you were to, this applies basically to imported services. For example, let's say we want to put up another twin towers or something like that in PJ. All right, and we are scouting for an architect, and we decide to hire an architect from Australia. Then his services are being imported. Right? So in this case, then the services being imported will be subject to GST. So the reverse charge will apply. So in this case, the company which is employing this foreign architectural service will have to charge input tax as well as output tax. So it has to play dual role because the person is outside the country, so we cannot ask him to pay GST. So we have to incorporate in our reverse charge. So you can see in this case, the person who's using the services, simultaneously the recipient can claim the GST charge as input tax. So he's doing both input tax as well as output, and he can claim the GST charge as input tax. So reverse charge affects partial and fully exempt taxable services. So when you're dealing with, even the goods may be exempted, but because we are dealing with services, it affects them if you bring it from overseas. So you can see in this case, I put in red there, non-taxable person is also required to account for reverse charge. So even a person who is not registered may have to charge GST in this case for imported services. Okay, let's look at supply. We say taxable supply. Only taxable supply is subject to GST. So let's have a look at what is meant by supply. So supply is all forms of supply, including supply of imported services done for a consideration. It means there is payment involved. Anything which is not a supply of goods, but is done for consideration, is deemed to be a supply of services. So if it's not a good, it must be service. So no alternative. Right, so this gives some detail. All forms of supply, including supply imported services, anything which is not a supply is done for consideration, is supply of service. Now consideration. Now these are examples of things which are not considered consideration. Right? So these are not, even though you're receiving money, it's not considered as consideration. So dividends, compensation, disbursements, loan repayment, grant, these are not consideration. So no GST is involved in this case. Now types of supply, you can see there are 4 Okay. Out of scope supply, exempt supply, zero rated supply, standard rated supply. Right. So out of scope means it's not taxable because we don't have the right to tax it. Right? We don't have the right to tax it. Exempt supply means the government has exempted it from being taxed. Right? So in this case, these are non-taxable supplies. Zero rated means tax at zero. Of course, you're not paying any tax because 0 times anything is 0, as you all know. All right. Standard rated supply will be, of course, at the rate decided now is 6%. So these are all taxable supplies. Now you may wonder why charge 0. You'll realize later that products or services which are 0 rated, the business would have paid input tax, right? When they buy the materials, they're paying input tax. But when they are selling to the next person on the chain, they can't charge the output tax. I mean, they can charge output tax, but it's 0, so they're not going to get any output tax credit. So, in this case, then, they can claim what they paid as input tax credit. Claim the input tax. Whereas in the case of exempt, they may have paid input tax on the goods, but because exempt, they can't charge. They can't charge GST. So the problem, of course, is they can't recover the input tax. So we do not know how they're going to deal with it. Somehow they'll use their brains and get it back up, I suppose. Probably from the customer. One way or other, they will pad it up and get it. Right? Okay, so out of scope, as you see, third country trading, so where third country is involved. So it's out of the scope of GST tax. Certain things like if you transfer your business, you're running a business, you want to transfer the whole business to somebody else, then there's no GST on it. But if you're going to sell your business piecemeal, that means you're going to sell your assets to various parties, then GST is involved. But if you sell the whole thing as a going concern, no GST. So out of scope. And then non-business transactions. Example, private transactions. So sole proprietors and partnerships have to record their business transactions accordingly. So private transactions must be recorded. Private is those things which are relating to personal use. So these are also out of scope. Pensions, provident, or social security fund. Now these are exempt. That means no output tax will be charged. Land use for residential, agriculture, or general use. Building use for residential purposes, education services, healthcare services. So these are not going to be subject to GST. They are exempt. Right? But as we mentioned just now, exempt means the businessman cannot recover his input tax from the customs. So these are the domestic transportation of passengers, financial services, childcare services, all these are exempt. Now zero rated, where tax is charged at 0, which means nothing, no tax at all. This affects, as you see, export of goods, specific supplies which the minister has gazetted, and of course, services which are provided to overseas international services. So zero rated, of course, better than exempt as far as the businessman is concerned because input tax can be claimed. Okay. So goods are deemed exported. So certain goods which are sent overseas. So these are cleared at the last customs station when it's going to go out of the country. The goods are loaded on a vessel or an aircraft which is about to depart from a port or place to Malaysia. So in this case then, of course, they are all being exported, that they are going to another country. The goods are cleared at an inland clearance depot or station on their route out of Malaysia through a customs port or airport. So any of these places deemed exported, even though they are still in Malaysia, as far as concerned, they are going to go for export. Okay, international services, as you can see there, international transportation of passengers, goods, etc. So all these things also exempt. Oh, sorry, zero rate. All right, so you can see there. These two are customer and client, and machine is sent over to overseas for repair, for example. So tax invoice from A to B can be zero rated. Standard rated service if machine is imported for repairs. Here we are sending our machine out. If from overseas a machine is brought in here to be repaired, then the companies involved will be charging standard rated. Whereas here, the machine has gone out to be repaired overseas. So it's zero rated. He can bill but at a zero rate. Some certain other things are zero rated. I think all of you know about electricity and water. So they're given zero rates for the first 200 units and 15 cubic meters of water for domestic consumption. And then for food for human consumption, all this have been given zero rates. So all of you understand what is exempt, what is zero rated by now. So exempt means they can't charge you output tax. But zero rated, they charge you, but at a zero rate, which effectively means also you don't pay. But the difference is, in the case of exempt, you cannot claim your input tax that you have paid to your suppliers. But in the case of zero rate, you can claim. Okay, so you can see quickly the comparison, zero rated versus exempt. So zero rated is considered as a taxable supply, whereas in the case of exempt is considered as a non-taxable supply. Charge GST at 0%, no GST is chargeable. Entitled to claim input tax credit, cannot claim input tax. Okay, so all other things which don't come under what we discussed just now as out of scope, zero rated and exempt will then be subject to the standard rate. So standard rate supply, that means 6%. It also covers including supply of capital assets. So when you buy equipment, that also will be subject to the 6%. Now this is a chart which unfortunately I'm not very good at flow charting. We're using this PowerPoint, so it doesn't give a very good image over here. So as you see there, we start asking questions. Is there a supply in Malaysia? And if the answer is no, then no supply. If the answer is yes, then we have to go down to this question here. Is it a supply of goods? If the answer is yes, we go along. Is it exported? If the answer is yes, then it's zero rated. If it's no, then we come down here. Is it a supply of service? or goods, exempt. If the answer is yes, then exempt. If the answer is no, then standard rated. SR here, I will put it in full, otherwise we're going outside, so it will be standard rated. And this side here is the supply of goods, and as you can see there, is it an international service or gazetted zero rated supply? If it's no, no tax. If it's yes, then it comes back to, as we said, supply of goods or service exempted. So if exempted, then no tax, is not standard. So it's not so good a diagram, unfortunately I couldn't improve. I exported this one to my son in Bangkok and asked him, can you edit it? But when I opened the email this morning, he had not replied. So I couldn't give you something improved. Okay, standard rated supply. All supplies other than out of scope, zero rated. You already mentioned this one earlier. Place of supply. Let's go quickly to place of supply. The place of supply is important because GST is charged if the supply of goods or services is made in Malaysia. Because as we said in the beginning, consumption in Malaysia.